Robert Schein, is CIO at Blanke Schein Wealth Management, joining us with his thoughts on the markets. Robert, it's a done deal, almost. Well, I shouldn't say it's a done deal because the Fed could surprise us, but let's say it's 25 basis points tonight. What happens next in terms of market positioning? What are you preparing for in terms of the communication that comes out from the Fed as far as its forward guidance is concerned?
Well, like markets, which are pricing in an 80% chance that tomorrow we will see a 25 basis point increase in the Fed funds rate. If you think about it year over year, how far we've come, how quickly we've come, ultimately the question is the press conference. What does Jerome Powell say, and how does he say it? Because ultimately, is it a hawkish hike or a dovish pause? We don't believe it's going to be dovish pause because it's credibility at stake for the Federal Reserve. If you keep in mind, a year ago they were behind the curve. Now they had to play catch up. But I mean, 2.5, 3 short weeks ago, the bond market was telling us a way different story, and we still have an inverted yield curve. It was more inverted since the 1981, the most we've seen. So the bond market volatility is the story. It's anyone's guess tomorrow. It's really going to come down to what the actual intentions and the words are going to be said from the Federal Reserve Chairman.
Do you play for safety then, Robert? I come back to my question. I mean, is a safe place to hide right now essentially the dollar index, gold, treasuries, short duration especially, and as we've been discussing, maybe some of the techs?
Yeah, absolutely. So where we've positioned our client portfolios is on the short end of the yield curve of the Treasury market. We've been saying that for over a year, and we've been communicating that to our clients in our newsletter. And ultimately, that's what's caught up to the short and midterm regional banks, if you will, because if you're going to get 4 to almost 5%, like we saw in the Treasury market just a few short weeks ago, versus what banks are paying, which is close to nothing, that's a tremendous safe play in the hideout, wait and see how this all plays out. Keep in mind, we still are above, the 6% range for inflation. So that's where the Fed has to thread the needle. They're dealing with the spillover effects. So that's going to create a lot of volatility, and that volatility will create opportunity. And that's why we're hanging out in the Treasury market and in the short end of the Treasury market. And then equities, large cap equities. And you're seeing the volatility provide tremendous opportunity all around.
What would you be suggesting that, I suppose not necessarily yourself in terms of your own allocation, but investors more broadly be allocating to cash right now? Because you're mentioning the shorter treasuries, but I'm talking about more of a percentage-wise. How much powder should people be keeping dry in expectation of what could potentially to come?
Yeah, we keep about 10 to 15% in the short term. Again, just keeping powder dry, rolling treasuries, having the opportunity for when we see, again, if language changes or if we get a CPI read that ultimately is favorable to the Fed. Keep in mind, the banking system now in the U.S. has the large banks taking over the small banks on a one-off basis, and sort of the government's backstopping that. What that ultimately could do, and keep in mind that the Federal Reserve did this in 94, did this in 98. They keep raising rates until something ultimately breaks. It happened in 94, it happened in 1998, long-term capital management. And so that pushes the pause on the Fed, but this is different inflationary environment this time. That's why we're cautiously optimistic. So as we keep about a 10% to up to 15% in short duration, but also at the same time, there's a lot of opportunity. Like I said before, one of the positions we like is Berkshire Hathaway. Warren Buffett's phone has been ringing off the hook this last week and a half. He's got $129 billion on his balance sheet, to $1.8 billion in terms of just repurchases this year. And if you go back to the last crisis, the great financial crisis of 2008, 2009, Warren Buffett made one-off deals. He made special deals. So I could see this playing the same way moving forward. And so those are opportunities where, listen, let's look at large caps. Let's look at companies that have been there and management teams and money managers like Warren Buffett that have been there before, and let the market come to him.
So it's an interesting way to play the second order, because the expectation would be that they'd be picking up deals on a song, and then you'd see that realised value playing through on a longer term horizon. But in terms of, because you mentioned big tech, and I know that you do like Microsoft, and what we've seen over the course of the last couple of weeks or so is this huge rotation out of the financials into a particular concentration of big tech that does have relatively robust balance sheets. In that respect, though, if you're an investor that's looking to buy today, would you be buying, and say you didn't have a position right now in Microsoft or anything else, would you be buying at these levels in order to take advantage of that, knowing that there is this potential downside risk to come, even if it's temporary for 6 months, 12 months? Or would you again suggest wait, but this is what you should look at if you are then going to deploy?
Well, as I said before, markets like these over the 6, 9, 12 months, it's why you keep your powder dry and you look for companies that you want to own on a 5-10 year basis. And if you don't own them, that's exactly why you want to step into the bellwether like Microsoft. Microsoft was down, a few months back, and now it's back up. And so if you want to dollar cost average your position, look, I can't time it. I don't think anybody can time it. But if you know good quality at value, you just start legging in and start taking advantage of the tremendous volatility that we've seen. You start a position and you continue to dollar cost average your way in. And over time, you also have to have the long-term mindset of, this is something that I want in my portfolio, not for a 6-month trade, but for 5-10 years down the road. That's why we're looking at markets right now, keeping cash and then taking advantage of the big techs. Ultimately, you're seeing what the big techs are doing. They're laying off, and they are going to get through, and they're protecting for the shareholders ultimately their bottom lines and their margins, because a lot of Wall Street's scratching their heads. Well, if you look at 2024, there's a 10% increase in earnings across the street, or across the spectrum, including in the tech arena. And how do you get there? Well, if you look at the Amazons, the Apples, the Microsofts, they're laying off 10,000 people like it's nothing. And ultimately what they're doing a couple quarters from now is they're preserving their margins.
But the thing about that, Robert, is that they're doing that to survive this year, right? But that's not a strategy that can be deployed every now and then. Like, you can't. At the end of the day, you need productivity, right? You need people, and the more important question there is the compromise on growth and the growth potential. Do you think that could be structural in nature, or could that come back?
Well, think of it this way. Why we like the large cap mega tech names, even in technology, if you will, is because their gas tanks and the reserves are full. So when we go into a period of time where it's a recession, or companies are having credit crunch, but they're small tech, and innovation doesn't stop because markets are down. Long term, these large companies can pick up these small companies, like Warren Buffett can pick up maybe some financial companies through this process. And that's what happens. The economy is scale, and they get bigger. That's why we say, listen, have a long-term perspective. Go with those companies that are well managed, but they have the gas in the tank, where the smaller tech, the micro tech companies that are worrying about their bank deposits and how much money they have on cash to survive the next 3 to 5 years can potentially be a suitor for these larger tech companies. And that's where the innovation sort of is a matchmaker through, again, these recessions or volatility.
Okay. Sorry. Very quickly, big energy. Would you buy big energy right now?
Yeah, there's a structural tailwind for energy. We've seen energy down year to date. It's up 2 to 3% right now. But energy for the long play, we do like energy, and anywhere from Chevron to Exxon to ConocoPhillips. Long term structurally, energy is a position in your overall portfolio. Keep in mind, even 2 years ago, energy was only 3% in terms of a sector weighting in the S&P 500. Now it's up to 6%. And going back to 1999, it was 27%. So there's room for growth for the energy markets, if you will. And if you don't own energy and you see opportunities, take advantage to put a little bit higher allocation to energy, because we believe energy has secular tailwinds.
And room for dividends too. Robert, we're going to have to leave it there. Thank you so much for your time. Really do appreciate it. That is Robert Schein from Blanke Schein Wealth Management.